What is up, everybody? Coltyn Simmons here again with my main man, Tye Prince with Fairway Independent Mortgage. I always just call it Fairway Mortgage, but Fairway Independent Mortgage. They're huge. yeah, they're formal. They're big. So one of the things we wanted to talk about today, and we kind of talked about it a little bit at the end of the last video, was let's get into the nitty-gritty of some of these loan programs, okay? So one of the main loan programs that's out there right now is gonna be the FHA program. So let's talk a little bit about credit scores, down payment, some of the things that you're gonna look at in detail for that FHA loan program, and maybe why it's beneficial or more attractive to some of the first-time home buyers.
Sure. So FHA is a great program. It allows us to go as low as a 580 credit score at Fairway, which is great for your first-time home buyers. Maybe your kid just coming out of high school, just moving out of his parents' home for the first time, or maybe somebody just looking to buy their very first home ever. They've been, struggling for their whole life, saving up money. The nice thing about the program, it allows as little as 3.5% down payment. So for example, on a $300,000 house, you need just about $10,000 out of pocket to be able to buy the house for the down payment. Like I said, super low credit scores. The nice thing about FHA, and when you are talking about interest rates, it really just takes into account your credit score. So there's no other variables, just your credit score is X, your interest rate would be, X. Okay. It's beautiful. It's a wonderful program for almost everybody to get into homes. The nice thing about it with the new loan limits that we discussed on our last video, all the way up to just about $420,000, that's quite a bit of home for your first time buyer. That gets you, the 3 bedrooms, the little bit bigger yards. It doesn't limit you like the stereotypes would say. It doesn't really limit you to like a condo or something.
Yeah.
It does open quite a bit of doors for your first time client.
And one of the things that we have to throw out there is that every county, I believe, is different with their limits.
Correct.
So here in Clark County, it's about $420,000. Now, if you're living in Pinellas County in Florida or somewhere, the loan limits are different everywhere. So if you're watching this video from another part of the country, another county, I would definitely reach out to Tye and find out what exactly in your county does that loan limit go up to, okay? So one of the things that we get asked a lot is, hey, Coltyn, I got an FHA mortgage right now. I'm looking to, maybe move up, but I wanna keep this house as a rental. The first thing I ask is, when did you buy that home? So when did you get that FHA mortgage? Because if you bought that FHA house in 2011, 12, 13, 14, 15, 16, 17, any of those years, you have 20% equity in your home. So right now, this guy right here can probably save you $250 to $350 like that, just by getting rid of your principal mortgage insurance. So even if you're not thinking about buying a house, right now is an amazing time to refinance your house out of FHA, so you don't have to pay that principal mortgage insurance. So that's one thing, and you can just reach out to him at, what is it?
Applywithtye.com.
Applywithtye.com, or just message us in wherever you see this and we'll reach out to you. But the other thing is if you're looking at moving up and you're gonna keep that home as an investment, reach out to Tye, figure out how the loan programs work. You can probably rent that unit out, okay? And what income you get from that rent will offset the mortgage to where now your debt to income ratio, when you go buy the new house, is offset with that additional income. So it doesn't hold you back from moving up. I've had to do it a couple times and it works out really simple. Reach out to us. We can show you how to do that. The other way is let's just say that you already found the house that you really love, okay? You found the house you love, but now, Coltyn, I gotta list my house and then I gotta wait. Well, that house is gonna be long gone. Well, listen, if you can get that house rented out, we can start that program of getting you into the next place ahead of time. So there's a lot of different ways that if you're not in the business, you don't know all the little tips and tricks, but that's what we're here for, okay? So FHA, those are some of the details. And again, guys, you submit with Tye your information, you can be approved in less than 48 hours.
Actually, if they get it in before noon, I can get their approval out the same day almost every time. As long as we get the documentations pretty quickly, it's a very quick turnaround.
In less than a day, you can be approved to start shopping for the next house. So I know Uncle John and Uncle this and Aunt Betty tell you at the dinner table how you need 40% down and it's gonna be this and it's a pain in the ass. Let the bricklayers lay the brick, let the bread makers make the bread, let the lender do the lending, let the realtor do the realtor stuff. When you have questions, don't take their advice. Talk to a professional, okay? Because I've had so many people come to me and say, you know, Coltyn, I just don't have 20% down to put to get into a house. And I said, well, let's look at that, because you don't need 20% down to buy a house. I might even be able to get you into a house with zero out of pocket. Who knows?
There are programs for that, yes sir.
We will know when you submit. So there's all types of grant programs, down payment assistance programs, culinary programs, teacher programs. I mean, what other programs are out there that people may not know about?
There's a whole bunch. The most popular one right now that in Clark County that we offer is the Home is Possible program. That is down payment assistance, like you mentioned. It does cover up to 5% of the loan amount towards your down payment, your closing costs, that kind of thing. So with the right contract negotiations, I have seen people come out of pocket almost $0 to buy a house.
Yeah. So just ask the questions, because if you don't ask, you won't know. Okay, and there is definitely, if you have a decent credit score and you can show income, we can more than likely get you into a house, period. Okay, so that's FHA. Let's talk a little bit about the details of what they need to get the conventional loan, and why would they go with a conventional loan over an FHA loan?
Sure. So a conventional mortgage is basically your traditional mortgage that your parents would talk to you about, that people think you need 20% down, 40% down. That's just not true anymore. We can go as low as 3% down. The conventional mortgage does need a little bit stronger credit score than, say, your FHA. We can go as low as 620. Okay. Conventional mortgage is awesome. It actually takes into account your whole scenario. So your credit score, your debt to income ratio, how long you've been at your job, how much money is in the bank, how much extra money you have. It takes the whole scenario into account, not just a credit score yes or no kind of situation. So it's a little bit more encompassing. It does offer significantly higher loan amounts, up in the 640s right now, okay. Which is great because, like we mentioned, that offers, that opens up a world of different options for you in today's market. Mm-hmm. With a conventional mortgage, the reason you would want to go that route, if you have the down payment, let's say you have 5% saved up, the mortgage insurance is going to be, in most cases, significantly less expensive than going with FHA.
Got it.
FHA's mortgage insurance is just a fixed rate based on how much you're putting down. Mm-hmm. Conventional takes into account your credit score, your debt ratios, how much you're putting down, the type of property. It takes into a whole bunch of things into account, which allows them to, offer significantly less expensive mortgage insurance options. The benefit to that, a little bit higher approval, you get a little bit more house for the same payment because the mortgage insurance is less expensive. Mm-hmm. And the best part, once you hit that 20% equity, the term that everybody talks about, that 20% down number, once you've made enough payments that you get to that, your mortgage insurance actually can be removed, further reducing the cost of your monthly payment for the future.
So what he's talking about is with FHA, it can't just be removed from an FHA. You have to actually refinance out of that. So like we were talking about before, is if you get to a point where, hey, I bought the house for $250,000, it's now worth $350,000 in today's market, call them, refinance, and remove that like that. So, and that could be a few $100s every month. So that's the benefit of it. Also,
I've seen it as much as $600 in savings because they were in a higher interest rate from like the mid 2010s, 12s, and they had the mortgage insurance. So if you've had your mortgage more than a year or two, it's definitely worth a look.
Yeah, definitely worth a look, because you could save yourself $200, $300, $400, $500, up to $600, maybe even more, who knows? Mm-hmm. But guess what, guys? You won't know unless you reach out to them. So information is great, but if you don't take action on it, it's worthless, right? So you could be saving this money right now, but you don't know unless you reach out. So reach out. I'm telling you, it's changed people's lives from being able to just get by to being able to have a little extra money in the pocket at the end of the month. So it's a good deal. Reach out, and he can do it for free. He can take a look at that and say, listen, it's worth your time. Let's get into it. Or you know what? I don't think at this time it's a good time. Let's take another look at it in a year. That's the reason why I use Tye, is because there's a lot of lenders out there. I just dealt with it last week. A lender tells our client, oh, you're good to go, you're good to go, you're good to go. The week of close of escrow, she goes, oh, you know, we actually misspoke. You actually don't qualify for this physician's loan because you have to be a physician for a year, and it was an accident that we gave you the approval. After almost 40 days in escrow, the lender tells them this. Do you want to know why? You want to know why? The reason why is because most lenders, they get your information, they go, oh, Betty's in escrow, great. Let's file this away. Their close of escrow date's in 30 days. Let's take a look at it in 25 days. So then 25 days comes along and you get this whole bunch of emails. Hey, I need this, I need this, I need this, I need this. After 20 days of not hearing anything, all of a sudden this lender wants to jump on it. And then they go, oh, by the way, you don't qualify because of this random thing that if found out earlier would have saved your earnest money deposit and put you in a lot better situation. But lenders don't do that. They tuck it away, they wait till the end, and you know what? This guy has a real bad habit of something. What's that bad habit that you tell everybody about?
I tend to be ready to close before everybody else is ready.
Yep, and it's true because you know what? He does the vetting on the front end so that we're not losing your earnest money deposit. Okay, you don't want to lose your earnest money deposit over something like this. So he does the vetting up front, make sure that you're qualified up front. So now we're ready to close in 16, 17, 18 days while all these other lenders.
So I'm at day 8 right now, and docs are going out tomorrow for closing on Friday on one of the ones from one of your other agents that just fell through from another lender.
So he's going to close a deal in 10 days. I have deals as a listing agent coming in and lenders can't make it happen in 35 days, 40 days, asking for extensions. You want to know why? I just told you. Because they're not doing their job up front, okay? But that's why when somebody comes in and has a problem, I say, listen, I'm going to send you to Captain Save a Loan. I literally call him Captain Save a Loan because there's been multiple deals where they're like, oh, we got to cancel, our lender can't do the deal, or classic, we can't get a hold of our lender. And I say, okay, well, you know what? We're not going to extend. As the listing agent, I'm telling you right now, you're going to lose your earnest money deposit. We're not going to extend unless you use Tye, get him your information, he'll shoot you straight, and he'll get it done. And you know what happens from all of this? A lot of those agents say, Tye was really great. We're going to start using him now. So he's using a lot of the agents that were in contract with me as a listing agent are now using him because they're like, he actually responds to me. He actually answers text messages. How many times have I sent you a text at like 10:30 at night? Hey man, I got a client, you're sending over your app right now. And you're like, yep, send them over, I'm ready.
Too often.
Too often to count. But here's the thing. It's not I'll call you back in 5 days when I get back from vacation. It's not if he's on vacation, he's like, I'm on vacation. However, I got my laptop with me. It's in your email right now. That's the benefit of doing business with somebody that really cares. Okay, and I'll tell you that right now. So we're getting a little off subject, but I just want to, I know, right? But I wanted to throw that out there because people get in a situation, they've bought one house in their entire life. They bought 2 houses in their entire life. They get to a point where they think that that's the norm. They think that shitty service is the norm. It's not the norm, okay? The way we do things around here is not probably, I would say the way we do things is not the norm anymore because so many realtors and lenders are so lazy and into this 4-hour work week BS that they don't take care of their business, right? So they have consumers, clients that don't know any better, and they just think that loans are supposed to take 45 days, 60 days if you're working with some of these big banks. That's not the case. It's not the case. When you work with us, you'll know what reality is and what we're capable of. But if you're in a situation where you're already working with a lender that you're already upset with, or a realtor not responding to your text or your phone calls, give us a call, okay? I don't call on Captain Save a Loan for nothing, okay? So back on subject. So conventional, we talked a little bit about that. Now for VA, what are some documents, and some of the things that they don't realize is some veterans actually come up and say, so I can buy a house with no money out of pocket, right? And I'm like, technically, you are capable of doing that. However, there is closing cost on VA loans. There is a closing cost on VA loans.
The same as any other loan.
Same as anything else. A realtor can negotiate, the seller pays some of that, but at the end of the day, you are responsible for your closing costs. That's different from down payment. So talk to us a little bit about the VA needs and stuff like that. You already said that the credit score can be up to down to a 580. Okay, let's talk a little bit about the details of VA.
Sure. So with a VA loan, like you mentioned and like we mentioned on the previous video, you can go as low as 0% down payment. You can actually buy a house with 0 down. The beautiful part about that is you only need a few $1,000s to be able to cover the closing costs. Closing costs typically range between $5,000 and $10,000, just depending on how much the house is, what the HOA looks like, things like that. It is a little bit of a variable, but it is pretty minimal. One of the biggest misconceptions with VA loans, and why in the previous video you mentioned how realtors say, oh, we're not accepting VA loans. It doesn't really affect the sellers like it used to. There's a misconception where the seller has to pay all kinds of extra closing costs, that kind of thing. The only fee that the buyer cannot pay is the pest inspection. So this is the inspection to make sure there's no termites, there's no wood damage, things like that on the property. That's the only fee that the buyer can't pay. So you could pay it, I could pay it, the seller could pay it, the seller's agent, and it's about $100 plus or minus. That's it. That's the sole difference to the seller. There are fees that are what's called non-negotiable fees, and the VA client can't pay those if the lender is charging what's called an origination fee. So as long as you work with a lender like myself who does not charge an origination fee, you can pay those fees up to 1% of the purchase price. So there's a little bit of wiggle room there. It doesn't affect the sellers at all in most circumstances. And in fact, it's usually a quicker loan process. It is an easier qualification process for our veteran clients. And in my opinion, it's one of the best possible things our government can do for our veterans, really kind of give you the hookup on buying a house.
Yeah. So I had a situation once where I had a client really loved a house. I looked it up. It says not accepting VA loans. And I'm like, oh geez, here we go. So I called the agent. I said, hey, I got a buyer, over approved. You're only asking, I think it was $525. They're approved up to $600,000, but it's a VA loan. Can I ask you a question? Why are you not accepting VA loans? Well, my seller just doesn't want to pay all those additional fees that come with the VA programs. And I go, okay, what fees are you talking about? Because I got a company here in town, Crispy Critters, that will do a pest inspection for $65. And that's the only fee that they can't pay. And guess what? I'm not going to ask your seller to even pay it. It's just my buyer can't pay it, but the lender covers it. So why are you not accepting VA now? Well, I didn't know that. Let me talk to my client. Calls me back 5 minutes later. Yeah, bring him by. I'd love to make a deal with you. So guys, you might have a listing agent that is, I got to choose my words politically correct, not the most intelligent, and not going to be able to educate you on the VA loan. It doesn't affect the seller, okay, period. Now, there's some things with the house that a VA appraisal might call out. Like I've had paint conditions called out, appliance conditions called out, because the appraiser's saying, hey, this house has problems. We need them addressed before the bank will loan on it. But that's not exclusive to VA, that's FHA. Conventional will let you get away with a little bit more, but
It's a little bit more lenient, yeah.
at the end of the day, an appraiser is going to do their job, but that's not going to affect the seller. So guys, you might be missing out on offers because your agent says, we're not accepting VA. And when they go to explain it to you, they just say, oh, you have to pay all kinds of extra fees. That's not true. So if your agent is telling you that, call me, fire them, and we'll get your house sold a lot faster for a lot more money, okay? So anyways, so those are the programs. One thing that we haven't really talked about is jumbo. Tell me a little bit about jumbo loans, where we should start thinking about jumbo loans. If somebody's looking at a price point of $800,000 and above, or where are we at when somebody needs to start considering a jumbo loan?
Sure.
And what do they need to expect for like down payments and credit scores and stuff like that?
Sure. So jumbos are actually a pretty unique product. They cover any loan above that 640 range for like that a conventional mortgage would normally cover.
Okay.
So once you go with the loan amount above that, there's still a couple options. For example, if you buy, let's say, $1 million house, you come out of pocket 10%, which is $100,000. We can do a second mortgage to cover the difference between the conventional loan limits and that $900 amount that you need. Mm-hmm. So there are options other than just a jumbo for loans above the conforming or conventional loan limits in the 640s.
Okay.
So that's one option. But a jumbo loan basically is for a well-qualified client, usually somebody who's not their first time buying a house, somebody who's a little bit more high-end, more fancy, you know, those kind of things. But what the loans do offer is as low as 5 or 10% down, depending on the program that you qualify for. They are a little bit more strict as far as your debt ratios. They have a little bit tighter tolerances, tighter limits, that kind of thing. But they're fantastic programs. We have them up to, I believe, $3 million right now, jumbo programs. So they're awesome. They can finance just about any home that your average, you know, client would be looking at.
Yeah.
And as little as, like I said, 10%, 5% down, we do have options.
Okay. So there's a lot of options. So if you're looking at that higher price point area, maybe $1 million, $2 million, $3 million, there are programs that we can put you in with 5, 10% down, 20% down. You know, it's not this, put 50% down if you're buying a $2 million house. You know, typically when you get up into those price ranges, your client can pay that, but they're at a price point where this isn't their first rodeo. And they know that if I put $1 million down on this house, that $1 million is going to sit there and not really work for me unless the home appreciates. Okay, the home will appreciate on average 5% a year. If I take that $1 million and instead put $500,000 down, and I put that other $500,000 invested into something that's making anywhere from 10 to 25, 30%, well then it's a better move for me to keep that money in my pocket, invest it somewhere else. Instead of making 5% a year on average, it could make a lot more. So there's a lot of different strategies that can go into purchasing a home. And the first thing that I ask a lot of people that are gonna pick their realtor is, ask them if they own a home, if they have owned a home, do they make investments? Because guys, why would you use a realtor that has never purchased a home? Why would you use them to sell your home if they've never personally sold a personal home? Because they can't relate to you. They're just gonna say, yeah, sign the papers. Yeah, well, the lender said sign the papers, sign the papers. If I've been through this before, I can say, I had the same thing happen to me. Hey, you know what? When I sold my house, this happened. You can relate. And that feels a lot more comforting than, I've never been through this before, so you're on your own. Please choose wisely. Okay, so guys, I would say it's more important than ever to choose who you work with wisely. Who you hire matters, and that's why we're here today, shedding some light in some corners that aren't really talked about a lot. And I would say who you hire is important. So give us a call and let us interview for the job of your realtor and your lender.
That's me.
All right, guys, have a good holiday season. We'll talk to you soon. Bye-bye.
Take care.